Again, great to have you on the show today. And if I move very quickly into your thoughts for the subnational market. Clearly, the big news for this quarter, or rather last quarter, was the inclusion of Nigeria into the JP Morgan Emerging Markets Bond Index. And we've seen yields come down dramatically. But are we now going to see the impact of those lower yields in the subnational space? We've seen Gombe take off with a 20 billion naira issue. We're hearing Ondo State is likely to start one at 14.5%. Your thoughts on the subnational space?
Okay, thank you for having me on the show, Wole. In terms of the subnational space, this year had been slow up till this week when you had the Gombe State bond that is technically closing today. So this year we have 47 billion naira. But the thing to bear in mind is that the federal government rates really drive the subnational rates, and they tend to price above. Typically, they have been some that price below. But with the inclusion in JP Morgan index with the 7 and 10 year bond pricing about 12.5, 12.7, it effectively means now that you can price, anywhere up to 15.5% and give a healthy premium to investors. So now that Gombe has closed at 15.5, they're actually probably about 200 billion worth of transactions that will close between now and the end of the year.
So I guess the fact that Gombe has closed now, it's obviously, if you like, sets a price, it sets a floor, it sets a ceiling, if you like, depending on the credit quality of the state. So I think the chances of seeing more deals is much higher now, don't you say?
Well, it's. I mean, Gombe.
Or do you think there are other factors that will play here?
Well, at this stage, it's really a case of bringing the transactions to the market. Some of them already have SEC approval. Some have advanced stages of getting approval. But by the time we're done this year, we should definitely surpass 157 billion in 2010 for state government bonds.
We know we've seen the crowding-out effect of the federal government bond market. And if we see several issues in the state government bond space, what's the capacity of the market to absorb them, in your view?
I think the capacity of the market is very significant, particularly for those issues that are eligible for pension PFA investment. Because when you look at the amount of state government bonds in PFA portfolios, probably about 3%. They can go as high as 20% depending on which kind of portfolio type the investors have chosen. So if you're only at 3%, when total outstanding PFA money is 2.7 trillion, between 270 billion and 540 billion can go into that sector. They only have about 70 to 100 billion in right now.
So for a foreign investor, of course, liquidity is very key. And we know that the liquidity of the subnational bonds is nothing close to what we have in the federal government bond space. For an international investor looking for higher yields, of course, 15.5% is a lot more attractive than the 12 to 13% we're seeing for the federal government side now. Your thoughts on how they should approach the subnational space, if at all?
Well, I mean, I think in terms of, you have had one or two foreign investors come into that space. When the federal government rates are attractive and are quite low, and people are looking for extra premiums, then that's when you see activity on the secondary state government bond market. So you've seen some secondary activity in the past, just not at the same level as the federal government sector, particularly because these issues are not deep enough. So each issuer only has 20, 30, 50 billion in the market. For a typical federal government bond, you have anywhere between 100 and 500 billion in issue. Right. And so you need that depth for liquidity. But as people issue more and more, as the states issue more and more, the same state issues more and more under a program, you will start to see increased liquidity.
All right, Egie, thank you so much for that perspective. Egie Akpata, head of debt capital markets at UBA, giving us a perspective on the subnational bond market.